Okay guys, so in this video we are going to discuss introduction under IFRS 3. So when we talk about IFRS 3 guys, we are talking about a business combination. This is the chapter that you are going to find when you are doing your group statement. So please make sure that you stay tuned, watch until the end so that you will understand all the principles that I'm going to introduce in this video, so that when we do part 2 for question paper, you will be able to flow with us. Okay, so when we talk about IFRS 3, is define the business combination as transaction or event where acquired obtain control over one or more business. So in other words, when we talk about a business combination, this is the first step when a business is purchasing another business, which means that all those processes that we need to do when we are purchasing another business, that's where we started from. Before we start to do those elimination intra-group that we are going to discuss when we do IFRS 10. So we have to start with a business combination. So the first step guys, when you purchase a business, obviously you have to deal with the consideration transfer. When we talk about consideration transfer guys, it simply means that this is the way that you're going to pay so that you can get a control, or you can get a power, or you can get a share of that company that you are purchasing. All right, so when we talk about consideration transfer, let me write it down. A consideration transfer, you need to understand this because this is going to be one of the questions from your examination or from your test. So a consideration transfer guys contain a lot of items that you are going to deal with it in terms of calculation. Number one, consideration transfer can be made in terms of cash. Okay, we can just write bank as an accounting term, but this is cash. We can just pay cash so that we can obtain a control. But however guys, this is not only the cash that can give you a control into another entity. Number two, you can do it in terms of finance. Finance, obviously you are purchasing through scholar, yeah, in a simple term. In other words, you are not paying cash, but you are going to pay through an installment. Okay, but this finance must be measured at present. It must be in terms of present value. Okay, because finance obviously include what? It also include interest. But when you recognize consideration transfer, make sure that you take out those interests and get what? A present value. Okay, number two, it can be in terms of assets transfer. Assets transfer. You can just transfer one of your assets that you have so that you can obtain what? A control. But these assets guys, it must be measured at fair value. Remember, you have as an accountant, you know that when we record our assets we use a book value, but when we do a consideration transfer in terms of IFRS 3, you have to measure it using a fair value or market value. Okay, and the other thing is contingent liability. Contingent liability. Okay, I'm gonna explain this. So when we talk about contingent liability guys, you can find that the company that you are purchasing, one of the owner was owing someone or was owing another entity. In order for you to go and obtain this control, you can go and pay that liability that the owner of that company or the owner of the share that you are purchasing was owning. Well, for example, let's say this person was owing another company 500. You can just go and pay that 500 so that you can obtain what? A control. Okay, now let's proceed. In order for you to recognize a business combination after all this consideration transfer, what you need to do, you have to proceed to acquisition method. IFRS 3 require an acquire to apply the acquisition method, which involves recognizing the fair value of identifiable assets liability and contingent liability. In other words, they're saying that after you have obtained the total of consideration transfer, now you have to use acquisition method in order for you to calculate whether it's goodwill or it's going to be gained from bargain purchase. Okay, this is what you are going to do now. Identifiable assets. Identifiable assets and what? And the liabilities. Okay, in other words, let's just simplify it and say net assets and net assets. So in other words, you need to compare the total that you are going to pay, 500,000, and what, and the net assets of that company, so that you will be able to know that this is a goodwill or this is a gain from bargain purchase. Okay, I'm gonna do example. First one is gonna be example of goodwill. Okay, in order for you to obtain a goodwill, this is what you need to find. A consideration transfer must be greater than the net assets. Must be greater than the net assets. In other words, if your consideration transfer, the amount that you paid is 500,000, and you find that the net asset is 400,000, we call it a goodwill, which you are going to recognize it as an asset. Okay, in other words, there is a future economic benefit, because what you pay, you paid more than what the business worth. The business worth 400, but you paid 500,000. This is not gain, but there is a future economic benefit, because two business now are going to combine, which means that they are going to help each other, which means that if we used to have two computers plus another maybe two from this side, now we are going to have four, which means that there is a future economic benefit. Okay, then gain from bargain purchase is opposite with this one. Okay, it's consideration transfer which is less than net assets. In other words, this side is 50 rand and this side is 70 rand, which means that what we paid less, but this worth more, which means that there is a gain that you need to recognize under income statement, under other income. Okay, then after that, guys, all this process which we are going to do example under part 2, we still have to apply IFRS 10 or IS 28. So when we talk about IFRS 10, we are talking about a consolidated or financial statement. You don't just consolidate, guys. You must first go through all this short process that I summarize. Then after that, you can choose whether the transaction, depending on how many percentage or depending on many factors, which please go and check IFRS 10 and IS 28 video, so that you will know that now you need to apply a certain standard. So I hope you learn something from this basic, which we are going to do a calculation on part 2. Please check part 2, and please make sure, guys, that you subscribe to this channel and also like this video and share with friends. I'm gonna see you on part 2.